Hey, Kyle here with winthehouseyoulove.com. In this video, we're talking about USDA loans versus the median US home price. So make sure you watch the first video so you can understand exactly what we're talking about with debt to income ratios here. So just a quick recap of our scenario. We're using a USDA loan, median US home price. So this is $347,500. We're going to use a 3% interest rate, minimum down payment, which is 0%, 1.1% in taxes, property taxes, 0.35% in insurance, homeowners insurance, and $500 a month in debt. So we're going to say this is maybe a car loan and a credit card payment. So here's the math of it all. Front end debt to income ratio is 33.99% with USDA. This is quite a bit lower than the other loans. And so we're going to need a higher income to be able to accommodate the much lower debt to income ratio. The back end debt to income ratio is 45.99%, and this is 0% down. So if we convert these into monthly figures, principal and interest is $1,479 per month. And USDA does have a funding fee in here of 1% of the loan amount wrapped into the loan amount. And that means we have to pay it monthly through the principal and interest payment. So we have to keep that in mind. USDA has a monthly mortgage insurance of 0.35%, so quite a bit lower than conventional and FHA, but it is $101 per month. Taxes would be $318, homeowners insurance would be $101, and that gives us a total monthly payment for a USDA loan of $1,999 per month. So let's figure out the front end ratio first. We'll bring this monthly payment figure over here and divide it by the front end ratio, 0.3399. And that gives us a front end income minimum of $5,881. All right, we're going to come back to that later. All right, now let's figure out the total monthly debt payments that we have at the moment. So we take the $1,999 plus $500. That gives us $2,499. This is our total monthly debt payments. We take that number and divide it by 0.4599, which is our back end debt to income ratio. And that tells us we now have $5,433 as our back end income minimum. So we have an issue here. We have two debt to income ratios that are telling us two income numbers. So front end ratio tells us we need $5,881 per month. And the back end ratio tells us we need $5,433 per month. So which is it? We have to go with the higher amount, right? Because if we took, let's say we only had $5,433 per month. Well, that works for the back end ratio, but then our front end ratio is too high. So we have to go with the higher number here. So we take $5,881 times 12, and that gives us $70,572 as the minimum yearly income gross needed for USDA loan for the median US home price. So if you're interested in learning more about USDA home loans and if you qualify and all of the requirements, go ahead and click on this video to learn more.